So, why is it that people can't think clearly about investing or decisions in their lives?
Well, they don't think very well about sex or gambling either.
Did you know that Charlie Munger, the vice chairman of Berkshire Hathaway and Warren Buffett's right-hand man, turned a mere few $1,000s into a multi-billion-dollar fortune? That's right. From a humble beginning, Munger's net worth now stands at over $2.7 billion. But how did he do it? Today, we're diving into the mind of Charlie Munger to uncover the 5 best strategies to multiply $250. Strategy number 1. The power of compound interest.
Well, the answer is I do believe in dividends in a great many situations, including many of the ones companies in which we own stock.
Compound interest is often described as the 8th wonder of the world, and it's a principle that has been at the core of some of the most successful investment stories. Charlie Munger is a prime example of someone who has harnessed this power to build immense wealth. Munger once insightfully stated, "The first rule of compounding, never interrupt it unnecessarily." This one sentence sums up his investment philosophy in a nutshell. Munger's investment strategy has always revolved around the long-term perspective, emphasizing the importance of allowing investments to grow through the power of compounding. He understands that the real magic of compound interest lies not just in the accumulation of interest, but in the exponential growth over time. A formula for compound interest might seem complex, but its implications are straightforward. Even a modest investment, like $250, can grow significantly over time. For instance, at a 7% annual return, compounded monthly, in 30 years, your $250 could grow to approximately $1,900. This growth is a practical application of Munger's philosophy, allowing your investments to compound over time without interruption. Warren Buffett, Munger's longtime business partner, is another example of the power of compound interest. Starting with small investments and letting them grow over decades has been a key aspect of his wealth-building strategy. Munger himself applied this principle, turning his initial investments into a multi-billion-dollar fortune. For everyday investors, the principle of compound interest works the same. It's about starting early, even with a small amount, and letting it grow over time. This approach aligns perfectly with Munger's advice to be patient and disciplined with your investments. Munger's investment philosophy isn't just about numbers. It's also about mindset. He believes in the importance of patience and discipline in investing. Allowing your investments to compound requires resisting the temptation to cash in early and understanding the long-term nature of wealth accumulation. Munger also emphasizes the importance of risk management in investing. He advises against chasing high returns without considering the risks. Instead, he suggests a compound approach, focusing on steady, long-term growth that complements the principle of compound interest. To apply Munger's philosophy to your investment strategy means understanding the power of compound interest and using it wisely. It's about making informed investment choices, being patient, and allowing your investments the time they need to grow. Strategy number 2, invest in what you know.
We favor the businesses where we really think we know the answer.
Charlie Munger, known for his sharp investment expertise, often emphasizes the importance of investing within one's circle of competence. He advises it's not a sin to miss a big opportunity outside of one's competence, but it is totally irrational to take big risks in areas where you have no edge. This principle is particularly relevant when considering how to invest a sum like $250. The concept of a circle of competence is simple. Invest in businesses or sectors you understand well. Munger believes that by doing so, investors can make more informed decisions and better assess the risks and potential of their investments. For a small investor, this could mean choosing companies or industries that they are familiar with or have experience in. When you invest your $250 into areas you know, you're not just relying on external advice or trends. You're leveraging your own knowledge and insights. This could mean investing in consumer goods if you have a knack for understanding consumer trends, or in technology if you have a background in tech. For instance, if you're a regular user of a particular brand or service and understand why it's popular, this might be a good investment opportunity. Munger himself, alongside Warren Buffett, has applied this principle to his investments, often choosing companies with simple, understandable business models. Munger's approach also highlights the importance of thorough research. He asserts you have to understand the competitive nature of the business you're in. If you don't understand it, you're not competent to figure out the economic future of your business. Therefore, investing your $250 should be preceded by diligent research and understanding of the chosen field. In essence, Munger's advice to invest in what you know is about minimizing risk and maximizing the potential for informed decision-making. By applying this principle to your investment of $250, you align your investment strategy with your personal expertise, thereby increasing the likelihood of success. Remember, in the world of investing, knowledge is not just power, it's profit. Strategy number 3, the margin of safety.
Yeah, that margin of safety concept boils down to getting more value than you're paying. And that value can exist in a lot of different forms. If you're paid 4 to 1 on something that's an even money proposition, why, that's a value proposition too. It's high school algebra, and people who don't know how to use high school algebra should take up some other activity.
One of the fundamentals of Charlie Munger's investment philosophy is the concept of margin of safety. Munger, along with his longtime business partner Warren Buffett, has consistently emphasized this principle as a key to success in investing. Munger eloquently puts it, the 3 most important words in investing are margin of safety. This strategy is crucial, especially when considering how to wisely invest a sum like $250. The margin of safety principle involves investing at a significant discount to the intrinsic value of a security, thereby providing a cushion against unforeseen adverse events or miscalculations. It's about not losing money by ensuring that even if your analysis is off or market conditions change unexpectedly, your investment would still be sound. For an investment of $250, applying the margin of safety means choosing investments that are undervalued compared to their actual worth. This could be a stock trading below its book value, a bond priced below its redemption value, or any asset where the price does not fully reflect its true potential. Munger believes that this approach not only protects the investor, but also provides an opportunity for a significant upside. Munger and Buffett have often applied this principle to their investments. They look for companies that are undervalued by the market but have strong fundamentals, such as a solid balance sheet, good management, and a competitive advantage in their industry. This approach has allowed them to make investments that are not only safe, but also highly profitable. Implementing the margin of safety requires thorough research and analysis. Munger advises you have to have the knowledge to enable you to make the correct decision. For an investor with $250, this means doing your homework to understand the true value of any potential investment and ensuring that you're paying less than this value. Munger warns overconfidence in one's investment decisions. He suggests that investors should always question their assumptions and seek a margin of safety. This approach is particularly important for small investors, as a significant loss can be much more impactful. Investing with a margin of safety also aligns with Munger's view on the psychological aspects of investing. He believes in being rational and disciplined, avoiding the emotional risks that can lead to risky investments. By focusing on safety first, investors can maintain a calm and rational approach to their investment decisions. Munger's investment strategy, including the margin of safety, is inherently long-term. He believes in the value of patience and the importance of allowing investments to reach their potential over time. For an investor with $250, this means not looking for quick gains, but rather focusing on safe, steady growth. In summary, the margin of safety is a fundamental principle in Charlie Munger's investment philosophy. It's about ensuring safety first, which in turn leads to profitable investment decisions. For someone investing $250, this means choosing investments wisely and focus on long-term value and safety. As Munger himself suggests, the goal is not just to make good investments, but to avoid making bad ones. Strategy number 4, avoiding psychological traps. Charlie Munger places significant emphasis on the psychological aspects of investing. He often speaks about the importance of understanding and avoiding psychological traps in investment decisions. Munger asserts, what you have to learn is to fold early when the odds are against you, or if you have a big edge, play very hard. This strategy is vital for anyone looking to invest wisely, including those considering how to best utilize a sum like $250. Psychological traps in investing often stem from common human biases and emotional responses. These can include overconfidence, herd mentality, fear of missing out, and anchoring to past prices. Munger believes that being aware of these traps and actively avoiding them is crucial for an investment success. One of the most common psychological traps is overconfidence. Munger warns against this, stating, the idea of excessive confidence in your own ability to do something is one of the most dangerous traps you can fall into. Investors often overestimate their knowledge or ability to predict market movements, leading to risky and ill-informed decisions. For someone investing $250, it's important to remain humble and acknowledge the limits of one's knowledge. Another trap is the herd mentality, where investors follow the crowd without independent analysis. Munger cautions, remember that just because other people agree with you doesn't mean you're right. This is particularly relevant in today's world of viral stock tips and social media-driven investment trends. Independent thinking is key to avoiding the pitfalls of the herd mentality. FOMO can lead investors to make hasty decisions, especially in fast-moving markets. Munger advises against getting swept up in market euphoria. He suggests that investors should focus on their long-term goals and not be swayed by short-term market fluctuations. Investors often anchor to the price they paid for a stock, which can lead to holding on to losing investments for far too long. Munger believes in the importance of being objective and making decisions based on current information, not past prices. He says the big money is not in the buying and selling, but in the waiting. Confirmation bias, the tendency to seek out information that confirms one's preconceptions, is another trap. Munger emphasizes the importance of considering opposing viewpoints and their information. He advises, we are all subject to confirmation bias, looking for evidence that confirms what we already think and ignoring contrary data. Loss aversion, where the pain of losing is more potent than the pleasure of gaining, can lead to irrational investment decisions. Munger suggests that investors should focus on the overall value and potential of their investments rather than being overly influenced by short-term losses or gains. Munger often speaks about the importance of rationality in investing. He believes that investors should make decisions based on logic and analysis rather than emotion. This is particularly important when investing smaller sums, like $250, where each decision can have a significant impact. In conclusion, avoiding psychological traps is a key component of Charlie Munger's investment philosophy. By being aware of and actively avoiding common biases and emotional responses, investors can make more rational and informed decisions. For someone investing $250, this means being cautious, doing thorough research, and maintaining a long-term perspective. Strategy number 5. Patience is a virtue. This principle is especially pertinent for those investing smaller amounts, like $250. Munger believes in the power of compounding and the importance of giving investments time to mature and grow. Patience also means resisting the urge to make impulsive decisions based on short-term market fluctuations. Munger's approach encourages investors to focus on the long-term potential of their investments rather than reacting to temporary market trends. So there you have it, 5 strategies from Charlie Munger on how to multiply $250. It's not just about where you invest, but how you think about investing. Munger's approach combines wisdom, patience, and a deep understanding of the market. Start small, think big, and who knows, maybe one day you'll be the one giving advice on how to multiply your investments.